Continue. Wow, haven't heard that lady before.
Yeah, she's new.
Yeah. Did you push the button? Because I didn't.
Yes.
Okay. Today's conversation is, or today's idea of the week is a continuation of the infinite banking concept. And specifically, how you would properly structure, we hear that term a lot, a properly structured policy to work with the infinite banking concept. If some of you are brand new, like you weren't at last week's all firm-wide meeting in person or tuned in, you might be a little bit like left behind, or we'll still try to catch you up. We'll recap a little bit. It is a total paradigm shift for a lot of people, and so it takes a while to kind of get it. And this is why this concept, as we've said several times, I think his name's Nelson Nash, is the creator of this concept. And there's an entire institute around this concept in Austrian economics. It's all about creating a bank for yourself and building your own bank. Nelson Nash says you should have your primary business, and then you should be in the banking business, and you can make money the same way banks make money. And this is we'll talk about that this next week. Brent Gritton, who many of you know from One America, who, like all of us, has been in the field, will speak on this topic. He used to lead with this. He goes to the annual conference all the time. That's another, so he will be doing from how he speaks to clients about this, how he introduces it. Anything you put on Nelson Nash into YouTube or any kind of searches would be a great place. You'll find all kinds of fans of his very unknown concept, probably, but when you search it, you can find a lot of people who say this thing is life-changing, this is awesome. And because it is, you'll always have some detractors. You'll have some people saying, I think it's a scam. I think it's just a way to sell life insurance, whole life insurance. And so you're always going to have that. And that's where I say, be a cynic, prove it out for yourself, look at it. The other individual that I have referenced a number of times, and I think I've been spelling his name wrong, Brent Kessler. Only one S, Kesler. And this was the video that Colleen said, sent out after last week's firm-wide meeting, and said, watch this. It's an hour and 45 minutes or an hour and 20 minutes. I think you got to watch at least an hour to get a good sense of what this concept is, how it works, how you make money with it, how your clients make money with it, how you create your own bank, do your own financing, and for your clients, for yourself, for your loved ones. And Brent has even though he's a bit of a goof, he's very successful at this. He is an independent, uses a lot of different life insurance companies, but you have to find the right one. And some of the Lafayette is one of the key ones, but he also loves Mass Mutual is one of them. but he also loves One America a ton. And I think I said last week, he himself has 100 applications pending right now, helping people create this, over $1 million in base premium. And Brent Gritton will probably speak a little bit to that. Brent now works for the One America Home Office and will share this concept. I handed out a number of the books of the R. Nelson Nash book, the guy who created this in the 1980s and founded it. And he's a bit of a, sometimes when you read his stuff, it's kind of hard. I have, can you see this book on the screen? Mapping Out the Millionaire Mystery by Brent and Chris Nagel. And this is an easy to read. I read it all in one day. Explains the concept. For me, I'm gonna either have people watch the concept, watch the Brent videos, or read this book. Like, I'm buying this book for my kids and saying, read this, see if you understand it, then we'll put this in place for you. That's how much of a fan I am of this. Realize though, you're going to be swimming upstream on this. People will say, I don't get it. It's too good to be true. It can't be. And so with that, realize that you're going to get people who are detractors. If you could just put in,
Dennis, real quick, what's the name of that book again?
Mapping Out the Millionaire Mystery. And it looks like this. And it's by Brent Kessler. Brent Kessler and Chris Nagel, N-A-U-G-L-E. Here would be my recommendation. It's $15,000. Thank you, Colleen. $15 for that. If you could just right now, just so I kind of have a sense of where different people are, and I see Leroy Mack joined. Leroy is affiliated with our the Wella umbrella, has a radio show, is building a team around this concept, has 25 plus applications sitting in One America on this deal. And so there's another person who is living this concept. If you could put into the chat, how many of you have watched the the Brent Kessler video that Colleen sent out last week after the firm-wide meeting? Just give me a sense if you watched any of it, none of it, some of it, just so I know where you're at in this whole. Thank you, Bill. Bill has raised his hand. I knew that. I watched some of it. Okay, cool. All right. All right. Okay, Dane. All right. I would encourage, I'm getting feedback someplace. I would encourage that for you to understand this, for you to be able to employ this, for you, Colleen, did you see Joanne's deal there? You didn't get the email? For you to employ this and really see it, to leverage it, you got to put some time in to study it. You got to read the book, you got to watch the video, you got to understand it. It's the only way that you're then going to be able to convey it to others. I'll share a few things on my screen here as recap of the last time we talked about this. So let's go here, 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 and here. All right. So it is a huge paradigm shift paradigm means the way that we perceive and think of things, and it involves the use of a whole life insurance policy, a properly structured whole life insurance policy. 9 times out of 10, or the way we were brought up, we thought of life insurance as death benefit, as covering a risk, as and it is that that when I die, the Brinks truck is going to back up to my house and drop off a boatload of money to replace the income that I create on a daily basis to protect my family. This is a shift that you are using the whole life policy for its living benefits, for its cash value accumulation and its loaning abilities and its tax abilities and its guarantees. And it is not an investment. So a lot of people will say, well, life insurance is a bad investment. One answer to that is compared to what? Compared to what you're getting at the bank? Or it is not an investment. Investment involves risk. It is, you should think of this as like your Chase savings account. And in replacement of your what you are financing, you are creating your own bank to do these things that you currently go to out to the third party world. You go out to and have an emergency reserve at the bank, and you reach to a credit card to buy something and then pay back that credit card immediately or over a period of time. Or you have an auto loan. You are creating your own financing company, or your client is creating their own financing company. Another great shift is that in this concept, you are paying yourself first. Most people go through and pay all their bills, and then they hang on to what's left at the end of the day, and that's what they store away. That's what they save. And you got to think of this in entirely a different situation. In fact, there's a great little exercise. If you did right now, if you started start jotting down your monthly bills. Have a piece of paper right next to you and just kind of think through this. What do I pay on a monthly basis? What are my monthly bills? Write them down, or at least in your head. What are my monthly bills? There's that mortgage, there's that auto payment, lease or loan. There's the groceries. I go there 4 times a month. And so I go to Costco 1 time a month and stock up on stuff. I've got my credit card bill of all the things that I've charged through the month that I pay that. I got Jane's credit card bill. And inevitably, none of us probably, when we thought of our bills, thought of ourself at the top of that list. And that's what you want to do in this mind shift is, how much am I paying myself first? That's the first thing. With my paycheck on a monthly basis, I'm paying myself first, and then I'm living on all the rest. That's the mindset you need to have in this concept. Most times people think of life insurance and they set it, they buy it, they set the premium, and they forget it. This is using your policy in a very active management way. Most people think of life insurance as a protection plan. It is, in this concept, it is a very efficient bank for yourself. All right, so let me get rid of that. So why do I want to do this? Why do I want to create my own bank? And this is the big reason why. One of the big reasons why. If the green lines are how much where the percentages of our money goes, our bills. And the red bar next to it is the amount of interest payments that go towards that. So if 20% of my annual spending is towards auto, and of that 20%, a full 25% of it is probably interest payments in the form of lease payments or auto financing, I can recapture that. I can be keeping that for myself. In the same way, housing, huge amount of it is an interest payment when I have a mortgage. When I buy things and I carry a balance on a credit card and I carry it forward, or I finance, I'm doing some remodeling at the house and I'm going to buy some fixtures, and while I do some long-term financing on that, that's interest payments. It's been estimated a full 35% of all our income is spent on interest payments. That's why you're doing that. Because you know who's collecting this? The banks and the third-party lenders. Third-party lenders are not you, and you want to become a first-party lender, that this money goes to you. And then if you say, well, I don't have any debt, this could be, it's also opportunity cost. You know, when people say they pay cash for things, they're actually losing the interest that they could be gaining by investing that money or saving that money. So again, we're creating a bank to capture this and to do this on our own. And when you compare, if I did this at an actual bank and what am I making at an actual bank, what, 0.1% interest in a savings account today, if that, sometimes zero. Within the structure of a life insurance policy, we're looking at 4%. Annually compounded, or compounded daily, and I get dividends in addition to that. So how do we always talk about properly structuring this. This is not the way to structure it. So here is, we're gonna use, now let me back up first on this here too. We're gonna just say, the first question people will ask is, well, how much should I be putting into this? How much? And this is an individual decision. This is to help people arrive at this in a number of different ways. I've heard it put this way. So are you worth yourself? Do you think you're worth $2.50 an hour? Well, yeah, that's absolutely. Well, what's 250 times 24 hours a day times 365 days a year? I don't know, that's something probably like $21,000. Well, there's no way I can put $21,000 a year into this. I just don't see that. I understand, Dennis, pay myself first. I understand what's kind of going on now. So you have to help a client look at this. Once they understand the concept and once they understand why it's so important to do this. And again, that's going to require watching the video. This weekend, spend an hour just watching the video. Buy the book, read the book. Another way I've heard this put is, are you, you work 8 hours a day, 40 hours a week. The first hour of every day is for you. Save it for you. First hour of every day. So how much do you get paid? How much do you get paid an hour? I make about 60 grand a year. I make $30 an hour. All right, $30 an hour time first hour every day times 5 on a 40-hour week. Let's look at that. $30 times 5 days times 4 weeks. That's $600 a month. $600 Okay, I think I can do that. Let's do $500 a month. $500 a month. So the thing to arrive at, and here is where we do a fact finder, and see where a person is at. And again, why are you building this system? Because you're gonna make money the way banks make money. You're going to save all those interest payments and recapture that for yourself. This is what the wealthy have done and continue to do. This has been around for 200 years of creating your own bank. And now people are using the whole life policy to do it. This is how Walt Disney built Walt Disney World. This is how Ray Kroc built McDonald's. This is how, interestingly, our current president, Joe Biden, has this system in place. I need to arrive at this dollar amount, you know, and let's just create a scenario here. Let's say we have a 35-year-old husband, wife, they're both non-smokers. And let's use that, you know, he makes 60,000, she makes 20,000, part-time, full, doing mostly the mom stuff. Let's say he has a 401k at work, he puts a little bit into that. Let's say they have a savings account, it has 20,000 in it. Why do you have that? Well, emergencies, where someday would like to buy another house bigger than this one than we're currently in. Let's say they have a car note that has 15,000 on it, debt. Let's say they have that's a car. Let's say they have a credit card, 6,000. It carrying over and over. They had to buy some stuff for the house, and they're making payments of greater than the minimum on this. This one they're paying, let's say, what do you like there? $450 a month here. Let's say here it's $200 a month here. You know, this is pretty typical, right? But that's not enough. They charge stuff on there, and they also pay some towards the balance. They're doing $500 a month into an IRA. They heard it's good to save for retirement beyond what they're doing. And so this is my typical scenario. And I say, I can help you tremendously. They watch the video, they understand, wow, if we could become debt free, we wouldn't have to pay these interest payments here and to here if I did this. We're not talking about buying life insurance in case you die. He actually has some term insurance, and she has some whatever over here that they're paying for. And they say, well, what can you put into this deal? And they go, well, really, we can't put anything into it. But if this is real, let's redirect this $500 a month that we're putting into the IRA. We'll let that just ride, and we'll put it into this personal banking system. We're going to create our own bank. It takes capital to start a bank. It takes money to get this thing up and running. Okay, yeah, we saw that video by Brent Kessler. We get it. We want to be part of this. We want to be part of the wealthy. We want to save on taxes. We want to create a income tax-free retirement. All right. This is how not to structure the policy. This would be, oops, hang on. I got to get rid of this. Sorry. Get rid of my whiteboard. This is $500 a month, and it's all going to base premium. And meaning I'm putting everything I can towards the death benefit. So it's maximizing the death benefit. This is not the optimal way to create your personal bank. And the reason why is because we're looking at this number in here, this net cash value area. We want this to grow as fast as possible. And this is obviously at the end of 1 year, it's still at 0. And so when we're creating this personal banking system, this is the area we want to drive. And we want to make sure that we don't have a MEC, because when it's a modified endowment contract, then it's taxed differently. Then if I take out anything from this policy, even in the form of loans, and that's what we're going to use, we're going to use the power of this policy in its loaning capability to get ourselves out of debt or make opportunistic investments. We're using it as a bank because we're going to make money the same way banks make money. Banks make money by taking in deposits and paying a little bit of return on that to the people who put their money there, and then loaning it out over and over at a greater rate. You're going to do the same thing. You're going to take money in on deposit, your money, get interest on it way greater than what the banks are paying, and then you're going to loan it out to yourself and pay off debt or make investments with it and pay yourself back. So this is not the way to do it. The way to do it is to put this PUA rider on the policy. And this is showing the illustration form. And I'm showing it to you so that you could design it yourself, but it's also, we are here to help you do this. So Christina knows this extremely well. Colleen knows this extremely well. To design the policy, if you came up with a person who says, okay, I got a person who is willing to put X amount of dollars, they're willing to do $1,000 a month into their personal banking system. They know it's their money, it's their bank. They're not paying for life insurance, they're putting it in the bank. Structure the policy perfectly for me. Okay, we can do that. And they're going to check this PUA rider. And in this case, it wasn't $1,000. It was $500 a month that this person's going to do. And typically a really good split, $500 a month or $6,000 a year, a really good split is that 60% of it is going towards this PUA rider. So 60% of 6,000 is $3,600 a year. This is creating the most amount of cash up front in this policy. So, whoops, that would look like this. When you click that button and go to it, so when I click this button, this rider, and then click on modal premiums right here in the middle of it, it will go to this little screen. And I'm going to tell it from year 1 to 65, I'm going to put in 3,600 into this. Here's the cool thing. This 3,600 is optional. It's flexible. So I can put in, if I only can put in for whatever reason, 1,000 this year instead of 3,600 because I got a demotion, I got less money coming in. This is why this system works extremely well for entrepreneurs. They sell a house, they're a real estate person. Okay, I can put in more. There's a limit on how much I can put into this PUA. So I can't put in too much. That violates federal rules. That's when they become a MEC, the TAMRA law. The government, when Walt Disney did this, and the Rockefellers did this, and Ray Kroc did this, they said, holy cow, people are creating a ton of money inside of their life insurance policies. They're not paying taxes on them. We're going to put a limit on this. When the federal government puts a limit on something, do you think it means it's a good thing or a bad thing? Often it's a really good thing. And so they're saying we don't want people to take too much advantage of this. And so they put a limit on how much you can actually put in this policy. And that's why we got to structure it so it doesn't become a modified endowment contract or a MEC. But my point on this is this 3,600 is flexible. I get a windfall, I can put in more up to the MEC limit. I have a downfall and I can't put in that 3,600. Okay, my bank isn't as efficient. I want to get money in my bank though. Why? So that I can loan it out. Because when I loan it out, I'm making money two different ways. So in this situation now, oops, let's get rid of that. I have, sorry, I'm putting in my $6,000. Why does it show here? Because I'm doing it monthly and there's a monthly handling fee. If I put the 6,000 all in once, it would show 6,000 here. Okay. Again, I'm focused on this total cash value column because I can loan this value out. The creators of this system say as soon as you're getting some showing positive values here, loan it out. So we could take $3,000 out of here to myself. I'm still paying in, I'm paying in my $500 a month. And I loan out 3,000 to go pay off some debt. And then I pay myself back with interest. How much interest? Again, don't be a dishonest banker. If you were paying the credit card company, if you paid off a credit card for $3,000 and you were paying the credit card while you had that balance 12%, well, you decide, are you going to pay yourself 12% or you're going to pay, I'm going to give myself a reasonable rate of return. I'm going to pay it back that 3,000 and I'm going to pay it back at $200 a month. And over what period of time? And I'm going to tack on 6% interest to my own payment. The idea is instead of it paying it to the third party company, I'm paying it back to myself. I've wiped out this debt and now I'm paying myself back. The three rules are always pay yourself first. So I'm contributing, pay self first, pay back loans with interest, be an honest banker, pay with interest, and recapture and recycle continuously. So as soon as I build up more balance, I loan it back out again. I can be halfway paying back this loan and have some additional amount I can loan out. That's what banks do. Banks take your deposit money and they loan it to the guy who's going to buy a car. They loan it to the guy who's going to buy a boat. They loan it to a person who's got a home equity loan. And they've got payments coming back multiple times. You can do the same. You're not loaning out your money. You are loaning out money from the general reserve of the insurance company. You're using your policy as collateral. And so it's key to know that my money continues to earn 4% compound interest. And then I'm loaning money using my policy as collateral and paying myself back. So I paid back that debt and I paid off that debt and I am paying myself interest. You will see then when you do that, this cash value grows geometrically faster, extraordinarily faster than what this is showing here. This is showing just the person putting in the contract payment. It's not, and just the 4%. It's not showing the loan piece coming back into this to the point where it will get too big too fast that we will start bumping up against this MEC limit. And the insurance company will say, you got to stop paying into this policy. You're gonna make it into a MEC. And this is when people start a second policy and do it again. Kessler and Nagel say about 90% of their people who buy into their system, who
Six or seven policies.
that 90% of the people who buy into their policies or buy into their concept and get a policy, get a second policy within 6 months. They say so that you continue to create the dollars that you can pay back your debt. Now, this isn't exciting, I suppose. People say that's only
Dennis, can I ask a question here?
Yes.
This only can be done with a whole life, like 95 or 121? Is not something to do with select?
You know, you can do it with select too. Very interestingly, in the book that I referenced, in the very end of the book, in very small print, they show several actual policies. And what I found comforting was they use One America whole life policies in several of their illustrations. They also use Lafayette. I've also heard Ameritas is a good one to use. But to answer your question, they use Whole Life 95, they use Whole Life 121, they use Whole Life Select. So here on page 121 is using a policy, Whole Life Select on a female age 40, created in January of 2020, and they show the actual illustration. Great question on whether you can use, does it have to be whole life? Yes, it does. This does not work with IUL policies because of the guarantees in the whole life policy of the 4% interest rate. And again, this is a great thing to put into your YouTube, and you can say, you can just put in whatever question you have in there. Can I use an IUL in infinite banking concept? And you'll get a bunch of little videos of people talking that through. Again, if you are a skeptic, and this is crazy, I've been in this industry for so long and I've heard about this and I never investigated this and I'm angry at myself, but I don't know, and most people will walk away from this and just say it's too good to be true. And no, I don't get it. And I can't wrap my head around it. And just like you, not you particularly, Juanita, just like the collective of us on this call, most of us didn't even watch the video between last week and this week. Most of us didn't read the book. And frankly, I realized that 5, maybe 10% of the people will be Leroy Max and will say, I get it. I'm going to study it. I'm going to learn it. I'm going to work on my language. I'm going to share this with people and people get it. And then and it's not a scam to sell. It's a way to help people get out of debt and create wealth. Here's probably my favorite way to create a policy. So let's talk about that person again. I'm gonna change up that scenario slightly. That person had, whoops, I just lost that, sorry. That person had, they made 60 grand. 35 this time on 20,000 really doesn't matter. They said we're going to put $500 a month into this. They also had they had $20,000 in the bank. That's what we said they had. And we said that they had a car payment of $450, a loan of $15,000. It was $450 a month. They have a credit card that they're carrying forward, $6,000, and they're paying $200 a month towards that. That was our couple. In this case, we said they really understood the system, and they say, why are we keeping this over at Chase? You know, we could be making 4% instead of less than 1%, 1/10 of 1%. And we could be loaning it out to ourselves and paying us back at least at 6%, maybe at 8%, whatever we're doing. We're going to match whatever we're doing here. If we're going to match the credit card payment, whatever, if we're paying 200 towards the credit card company, we're going to pay 200 to ourselves. We're going to wipe this out. And then instead of making this payment here, we're going to make it to the credit card of Dennis Gorski. So this couple did just that. And I got to bring up I dropped my illustration, sorry. So I got to bring it back up here. This couple said, we're going to take money out of our savings account. We're actually going to check this PUA rider and put $3,000 a month there, or $3,600 under this modal premium. And we're going to do a one-time dump. We're going to move $10,000 from our Chase Bank and put it into this bank, the Bank of Dennis Gorski. All right. That's what then this policy would look like. It would create immediate cash value. And again, the practitioners of this concept say, go and use this money right away. Pay yourself twice, because you're going to make 4% on the deposit. Even though I loan it out, the full 11,000 is still making money every month. And I'm using this as collateral to take a loan out from this bank. And I can take 6,000. So I'm going to take 6,000 out and pay that credit card off all in one fell swoop. And instead of making those payments to the credit card company now, I'm paying back the $6,000 I made here. And then I can, as I pay it back, then I can say, all right, now I have 15,000. I'm going to take out that 15,000 and go and pay off my car. And I'm going to pay it off all in one fell swoop. And now my car is free and clear, but I got a $15,000 debt, and I'm going against it from this insurance company using my policy as collateral. And instead of making the $450 payment to them, I'm making it to myself. And this column will grow crazily to the point where I then say, wow, could we do this? I'm now debt free. You know, this family maybe was renting. What could we do? And this is what Dave said to us. Dave Swanson, who's a practitioner of this, he said he's going to buy his house next year, and he's going to pull out his 20% down right from his policy, and then pay himself back and grow. That's the concept of how you do this. You look at just, this isn't even showing the debt payments coming back in, but you look at how much this is growing. You know, here, once we've capitalized our policy, you know, 38 to 45, it's growing more than what I'm putting into it every year. So there's this death benefit out here. And this family probably would say, you know what, why are we paying for our term insurance? Let's drop that payment. We only had $100,000 each of term insurance. Let's do this. Again, Nelson Nash says, the great calamity, the great risk in our society today is not that people are underinsured. Yes, they are. But that they are paying all these financing charges, and they out to and never recouping them, because they just think that's the way you have to do it. And that we've sold life insurance policies all in the wrong way. that we've focused on this. And I'm hugely one of this. I call life insurance the great I love you. You buy it for somebody else. You buy it for this death benefit should something bad happen. But we've missed the incredible opportunity of what's happening with this policy. One, the guaranteed increases, 4%, 4%, 4%, and the ability to loan it out. Loaning it out is a tax-free deal, and then making the money that way. Because when I loan out this money, it does not diminish the ability of it to continue to earn interest on itself. So I think the opportunity here is huge to simply be going and asking people, do you have a savings account today? You know, in our fact finding, if I can help you, you're probably paying 35% of all your money in some type of interest payments. No way, it can't be that much. All right, let's figure out what it is for you. Let's look at what, if you want to prove me wrong, all right, what if it's only 25% in interest payments? If you have a mortgage, it's a really scary proposition to look at how much goes for interest and how much actually reduces the principal. And it's all weighted up front. The interest payment is all up front in the beginning of the early years of the mortgage. And every couple years we refinance, and they make it really attractive. They say, this is a great deal. And you know why? Because they're making a ton of money off of us. The way the mortgage industry is the worst. In a car, at least it's a pretty equal deal, but the car depreciates so fast too. I buy a car and it depreciates to, the day I drive it off the lot. And then I'm giving them interest payments on that as well. And, even though for those people say, well, I pay cash for my car. Well, you do, but then you've lost the opportunity to earn interest on that. So if I could be my own bank and make 4% and make 6% because of the repayment of the debt, and I collect this as opposed to a third-party financer, wouldn't I be in a better shape? So again, when I approach people and say, would you like to recapture all this interest? Would you like to create your own bank so you make money how banks make money? Do you understand how banks make money? Why do they have such beautiful buildings and they're able to pay somebody to just sit at a desk and wait for somebody to come in? And they have just all this incredible property. You know how they make money? Because of the money that you go and put in on deposit there, they then go and loan it out time and time and time again. They give you 1% on a savings account, maybe 1% on a CD, and they're loaning it out several different times at different rates, multiple times. Why don't you own a bank? There are people who have created this and now are loaning their money out to other people. Meaning like their kids. Okay, I can pay off your credit card for this, but you got to pay me back. That's down the road. We'll talk about in a couple weeks the MAC method. It's a huge way of what Leroy's doing of using qualified money of people who are at that sweet spot of age 60 and showing them how they can create a tax-free retirement income using this method. But first you have to understand just the banking concept. Brent Gritton's going to talk about that next week of how he approached people. This is new. I understand the concept. I haven't gone and told enough people. My answer right now is to go to people and say, how much are you paying in interest? Do you currently have a savings account? Do you have any, savings account and a little bit of money in there? Why do you have it? Are you paying any debt? would you like to recapture that? Would you be open to me showing you a completely against the stream way of making money the way banks do, but you make it for yourself? This is people who have captured this and are doing this are making, getting themselves out of the rat race of the debt deal and becoming wealthy. Is that something you'd be open to listening to? Sure. Okay. Yeah. I kind of get you, but I don't get you. Yeah. I mean, you're jumping all over the place, Dennis, and that's where you got to get your language down. But the next place I would send them is I'd say, you need to watch this video. Go watch this Brent Kessler video. And the moneymultiplier.com. 9 steps. Watch the whole thing. Watch one part each day. Understand it. Okay, once you have watched this video, come back and talk to me. And if they won't do it, well then, okay, I don't have somebody who's willing to swim upstream. I'm going to just be forever in debt. I'm going to be forever just scraping by. I'm going to be forever paying the banks and the credit card companies money. This is not a get rich quick scheme. This is a discipline. I have to follow the 3 rules. Pay myself first. And so you got to start there. How much are you willing to pay yourself first and commit to? $500 a month. But what happens if something goes wrong? Well, we have this PUA thing. If something goes wrong, we can break out of that, but I want you to commit to this $500 a month. Okay, I'm willing. We're going to do that. We're going to definitely do that. We're on board. We watched the video. We're up to it. Okay, now we're going to design the policy. We're going to design your bank and realize it's going to take some capital up front to get this thing going. But if you have juice that we can give it from a savings account, you got another extra $5,000 that you're going to move from your savings account into your bank, every bit helps. We'll design this. And as soon as we get it, we're going to loan it out to ourselves. But you have to be an honest banker. And an honest banker pays back the loan, because technically you don't. You can take a loan against your life insurance policy and let it ride. And I have been a dishonest banker. True confessions, I have amazing cash value in my life policies because I've been selling the stuff for 30 years, and I've had some loans and I've just let it ride. I'm not an honest banker. I'm becoming one right now, though. You have to pay yourself back, pay back with interest. And if you're paying the third-party company interest, pay yourself interest. Don't demean yourself. Believe in yourself. Believe in your bank. Don't rip yourself off because you can. If I'm paying the car company 6%, I'm going to pay myself 6%. Pay yourself back with interest and then do it again. Every time I get a balance again, recycle and recapture. Do it again. Loan it out again. That's exactly what banks do. We're at our time. The biggest thing I can tell you, if this intrigues you, if you're like, wow, there's something there. And these guys tell a story, like Brent tells a story where he was at a conference and he had all this debt and he went and saw this and he said, wow, I should do that. I should look into it. And he didn't. 2 years later, he went to the same conference. It was a chiropractor conference. And there were some people there that adopted the deal and met with the guy. And they were like, holy cow, what a difference this is making. They're 2 years into it and they're just like, this is awesome. So he started 2 years too late. He left his chiropractic business and now he just focuses on this because he knows what a difference it can make. So if you're intrigued, or if you're a skeptic, or if you're like, man, I got to see this for myself, I mean, people have done transformational changes. Go and study yourself. Go watch the video. Go order the book. Read it over and over. Do it for yourself. Bring someone who's interested to the table. I can line up people or myself that can have conversations with them. Leroy Mack would be happy to share this, how he does it with you and your client in split business. Dave Swanson would be happy to, he's a certified practitioner of this deal. He's gone to the Institute. This isn't just some snake oil crazy idea that Dennis came up with and some guy wrote a book about. Do the research, swim upstream for yourself. And we're staying with this because I am convicted. You can choose to not attend. That's always your call. Brent Gritton is going to be on next week. And he will share how he, how he talks about it. And he's a really good explainer. I always find his stuff, people get it when they talk about it. A lot of times you got to hear different people explain it. If it doesn't work with Nelson Nash, it doesn't work with Brent, doesn't work with Dennis, maybe I need to hear how Leroy Mack says it. Maybe I need to hear how Dave Swanson says it. Maybe I need to hear how Brent Gritton says it. Okay, cool. One other announcement I wanted to make, our June 23rd meeting that we announced, I did not realize I'm putting it right on top of the NAFA conference. The NAFA conference is our lobbying and educational industry organization. NAFA is having their summer conference on June 24th. And so on the 23rd, they have their people arrive there. This is in Peoria. Cheap, I think it's $50 to attend. If that's, I am definitely going, others are going. Ray Shimizu is speaking on a panel down there and doing a presentation. Always good to be collaborating. I'm gonna go down the night before, stay, and then the meeting's on the 24th. Because of that, we will not have a firm-wide meeting on the 23rd that we announced last week. Well, there'll be more about that if you are interested yourself. Chris Gandy will be there. Chris Gandy is on the national NAFA board. We are huge advocates of what NAFA does and what resources they bring to the table for financial services. One of the big things they do is lobby to Congress to make sure that the buildup of cash value inside a life insurance policy is not taxable. That's huge to us. That's why we can do this with such, when you have a CD, you're getting a 1099. When you have a mutual fund, you're getting a 1099. That's non-qualified. You're not getting one on your own personal bank. When you loan it out, you're not getting a 1099. None of it's taxable. And then when I get to retirement, I can create an income stream. Again, if I do it in the right way, that is not taxable. Just unreal. And then when the death benefit pays out, it's not taxable. It's a wonderful vehicle that we should be using beyond just its death benefit capabilities and beyond its rainy days, some days way in the future. No, use it on a daily basis, load it up with some cash, capitalize it, make payments to it instead of your third-party financing companies. All right, 10:02. I'm happy to have one-on-one conversations about this, to share my materials, to point you in the right directions. Just reach out. Happy to have all of you here. And we are done for the day. We can open up for any questions or comments if anybody has any. Otherwise, we're done with the official time here. Hi, Jeff Drucker.
Hi, Dennis Gorski.
I sent you an email about a time we got to get together.